The Ghana Cedi has lost over 70% of its value in just the past 5 years. While you were watching this video, the Cedi probably dropped another fraction against the dollar. This isn't just numbers on a screen, this is a currency in freefall, and the story behind it reveals one of the most dramatic economic collapses in modern African history. By the end of this video, you'll understand exactly why Ghana went from being Africa's golden child to facing its worst financial crisis in decades, and why this matters far beyond Ghana's borders. Picture this. You wake up in Accra, Ghana's capital, and the money in your bank account is worth less than it was yesterday. Not by a little bit, by a lot. This has been the reality for millions of Ghanaians, watching their life savings evaporate in real time. The Ghana Cedi, once a symbol of the country's economic promise, has become a cautionary tale of how quickly things can spiral out of control. To understand how we got here, we need to go back to Ghana's golden era. For years, Ghana was the poster child of African economic success. The country had discovered significant oil reserves, gold production was booming, and cocoa exports were generating steady foreign exchange. International investors were pouring money into Ghana, attracted by its democratic stability and seemingly robust economy. The government was spending big on infrastructure projects, and everything looked rosy on the surface. But beneath this glittering exterior, fundamental problems were brewing. Ghana was living beyond its means in spectacular fashion. The government was borrowing heavily, both domestically and internationally, to fund ambitious projects and maintain popular social programs. Public sector wages were increasing rapidly, and subsidies on fuel and electricity were draining the treasury. Most critically, Ghana was earning foreign currency primarily from commodity exports, but spending that currency on imports of almost everything else. Here's where the debt sustainability crisis begins to take shape. Debt sustainability isn't just about how much money a country owes. It's about whether that country can realistically service its debt obligations without compromising its economic stability. Think of it like a person taking out multiple credit cards to pay for an expensive lifestyle. Initially, it might work, but eventually, the monthly payments become impossible to manage. Ghana's debt-to-GDP ratio began climbing steadily. In 2010, the country's total debt was around 37% of GDP. By 2022, it had skyrocketed to over 100%. This explosive growth happened for several interconnected reasons that created a perfect storm for currency depreciation. First, Ghana developed what economists call a fiscal addiction. The government became dependent on borrowing to fund its operations and ambitious development projects. Every year, the budget deficit grew larger, meaning the government was spending far more than it was earning in taxes and other revenues. To bridge this gap, Ghana kept issuing more bonds and taking on more loans. The international dimension made things worse. Much of Ghana's borrowing was denominated in foreign currencies, particularly US dollars. This created a dangerous mismatch. Ghana was earning revenues primarily in cedis, but owing debt payments in dollars. When your currency weakens, your debt burden automatically increases, creating a vicious cycle that becomes harder and harder to escape. Ghana's export base, while valuable, was also problematic for currency stability. The country relied heavily on gold, cocoa, and oil exports for foreign exchange earnings. Commodity prices are notoriously volatile, and when global demand shifted or prices fell, Ghana's ability to earn foreign currency was immediately impacted. Meanwhile, the country was importing almost everything else: fuel, manufactured goods, food, technology, and machinery. This trade structure created constant pressure on the Cedi. Every month, Ghana needed more dollars to pay for imports than it was earning from exports. Basic economic principles tell us that when demand for dollars consistently exceeds supply, the local currency must weaken. It's like an auction where more people want to buy than sell. Prices have to go up. The COVID pandemic turbocharged these existing problems. Global supply chains disrupted, commodity demand fluctuated wildly, and Ghana, like many countries, had to spend heavily on health responses and economic support packages. But unlike developed countries with strong currencies and deep capital markets, Ghana couldn't simply print money or issue debt without serious consequences. International investors began losing confidence in Ghana's ability to manage its finances. Credit rating agencies downgraded Ghana's debt multiple times, making it more expensive for the country to borrow internationally. Higher borrowing costs meant Ghana had to allocate even more of its budget to debt service payments, leaving less money for essential services and development projects. The psychological aspect of currency depreciation cannot be understated. Once a currency starts falling rapidly, panic can set in. Businesses and individuals begin hoarding foreign currency, expecting further depreciation. This hoarding reduces the supply of foreign currency in the market, accelerating the depreciation they were trying to protect against. It becomes a self-fulfilling prophecy. Ghana's domestic policies also contributed significantly to the crisis. The country maintained an overvalued exchange rate for political reasons, making imports cheaper but exports less competitive. Fuel and electricity subsidies, while popular with voters, cost billions of cedis annually and had to be funded through borrowing. The public sector workforce expanded rapidly, increasing government wage costs without corresponding increases in productivity or tax revenues. Interest rates became another crucial factor. To attract foreign investment and slow currency depreciation, Ghana's central bank had to maintain very high interest rates. At some points, benchmark rates exceeded 25%. While this helped attract some foreign investment, it also made borrowing extremely expensive for domestic businesses and individuals, slowing economic growth and reducing tax revenues. The debt service burden grew so large that it began crowding out other government spending. By 2022, Ghana was spending over 70% of its tax revenues just on debt payments. This left inadequate resources for education, healthcare, infrastructure, maintenance, and other essential services that actually drive economic growth and development. International financial institutions and development partners began expressing serious concerns about Ghana's fiscal trajectory. The International Monetary Fund repeatedly warned about debt sustainability risks, but these warnings went largely unheeded until the crisis reached a breaking point. The energy sector crisis added another layer of complexity. Ghana's state-owned electricity company accumulated massive debts, requiring regular government bailouts. The energy sector's financial problems spilled over into the broader economy as businesses faced unreliable power supply and higher electricity costs, reducing competitiveness and economic growth. Currency depreciation created a particularly vicious cycle for debt sustainability. As the Cedi weakened, the local currency value of Ghana's foreign debt increased dramatically. Debt that might have been manageable in dollar terms became crushing when converted to cedis. This forced the government to allocate more and more of its Cedi budget to debt service, reducing funding available for productive investments. Banking sector problems compounded the crisis. Several domestic banks faced serious capital adequacy issues, partly due to their exposure to government debt and the broader economic downturn. Banking sector instability reduced confidence in the financial system and made it harder for businesses to access credit for expansion and job creation. The informal economy, which employs a large portion of Ghana's workforce, was particularly vulnerable to currency volatility. Small businesses that imported raw materials or goods for resale saw their costs increase dramatically as the Cedi weakened, but they couldn't always pass these costs on to consumers who were also facing economic hardship. Agricultural productivity, despite Ghana's natural advantages, remained disappointingly low. The country continued importing significant quantities of food that could theoretically be produced domestically. creating ongoing demand for foreign currency and reducing the multiplier effects of agricultural spending within the domestic economy. Political economy factors also played a crucial role. Electoral cycles created pressure for increased spending before elections, regardless of fiscal constraints. Opposition parties typically promised even more spending, making it politically difficult for incumbents to implement necessary fiscal adjustments. This political dynamic made serious fiscal reform nearly impossible until crisis forced action. The global economic environment shifted against commodity exporters like Ghana. As developed countries began raising interest rates to combat inflation, capital flows reversed direction, with investors pulling money out of emerging markets to take advantage of higher returns in safer markets. This reduced the supply of foreign investment that Ghana had become dependent on. Regional economic integration remained limited, meaning Ghana couldn't easily access alternative markets or sources of foreign exchange within West Africa. Most trade was still oriented toward former colonial powers and other distant markets, keeping Ghana vulnerable to global economic shocks and transportation disruptions. Youth unemployment became a critical economic and social challenge. With limited formal sector job creation and a rapidly growing young population, economic opportunities remained scarce. High unemployment meant lower tax revenues and higher social spending pressures, worsening the fiscal position. The tourism sector, which could have been a significant source of foreign exchange, remained underdeveloped relative to Ghana's potential. While the country has rich cultural heritage, beautiful coastlines, and historical sites, tourism, infrastructure, and marketing remained inadequate to capture market share from other African destinations. Infrastructure deficits, particularly in transportation and logistics, increased the cost of doing business and reduced Ghana's competitiveness in regional and global markets. Poor roads made it expensive to transport goods to ports, while inadequate port facilities created bottlenecks that increased import and export costs. The education system, while improved from historical standards, still wasn't producing graduates with skills that matched labor market demands. This skills mismatch reduced productivity growth and made it harder for Ghana to move up the value chain in manufacturing and services. Climate change began imposing real economic costs through unpredictable weather patterns that affected agricultural production and required increased spending on disaster response and adaptation measures. These costs came at a time when fiscal resources were already severely constrained. The path forward for Ghana requires fundamental structural reforms that go far beyond short-term stabilization measures. The country needs to diversify its export base, improve agricultural productivity, develop competitive manufacturing capabilities, and build a more robust service sector that can generate foreign exchange and create quality jobs. Fiscal discipline must become a permanent feature of Ghana's economic management, not just an emergency response to crisis. This means building institutional capacity to resist political pressures for unsustainable spending and developing more reliable revenue sources that don't depend heavily on commodity price volatility. Exchange rate policy needs to reflect economic realities rather than political preferences. Maintaining an artificially strong currency might feel good politically, but it ultimately makes the eventual adjustment more painful and economically damaging. The debt crisis that precipitated the Cedi's collapse serves as a warning for other developing countries. Debt can be a useful tool for financing development, but only when it's used productively and kept within sustainable limits. Ghana's experience shows how quickly things can spiral out of control when fundamental economic principles are ignored for too long. Understanding Ghana's currency crisis helps explain broader patterns in global economics. Many developing countries face similar challenges with commodity dependence, fiscal pressures, and currency volatility. Ghana's story is ultimately about the challenge of building sustainable economic growth in an interconnected but unequal global economy. The human cost of currency depreciation extends far beyond abstract economic statistics. When a currency loses 70% of its value, it represents millions of people watching their purchasing power evaporate, their savings disappear, and their economic opportunities diminish. Behind every percentage point of depreciation are real families struggling to afford food, education, and health care. Ghana's crisis also demonstrates the importance of early intervention in debt sustainability problems. By the time currency depreciation accelerates, many policy options have already been foreclosed. Prevention is always better than cure, but prevention requires political will to make difficult decisions before they become unavoidable. The international community's response to Ghana's crisis will influence how other countries facing similar challenges approach their own economic management. Successful resolution could provide a template for debt restructuring and economic reform, while prolonged instability could discourage necessary but politically difficult reforms elsewhere. Looking ahead, Ghana's recovery will depend not just on stabilizing the currency and restructuring debt, but on building the institutional capacity and economic diversity needed to prevent similar crises in the future. The country has natural resources, human capital, and democratic institutions that provide a foundation for recovery, but realizing this potential will require sustained commitment to economic reform and good governance. The Ghana Cedi's depreciation crisis represents more than just a currency in trouble. It's a case study in how economic imbalances can build up over time and eventually overwhelm a country's ability to manage. For Ghana, the road to recovery will be long and difficult, but understanding how the crisis developed is the first step toward building a more sustainable economic future. The lessons from Ghana's experience extend far beyond West Africa, offering insights for any country trying to balance development ambitions with fiscal reality in an increasingly complex global economy.